Hey everyone, and welcome back to your Money Your Way YouTube channel. Today, we're diving deep into a household name in Singapore, the supermarket giant, Sheng Siong. You've probably shopped there, maybe even watched their TV show. But what's the story behind the stock? In this video, we'll unpack Sheng Siong's current financial standing, break down its strategy, look at the intense competition in Singapore's grocery scene, and explore what the future might hold for this retail powerhouse. Is it a resilient giant or facing tough headwinds? Let's find out. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Sheng Siong's story is quite remarkable. It started back in 1985, not as a supermarket, but as a single pork counter run by the Lim brothers in a struggling store. Fast forward to today, and it's one of Singapore's largest supermarket chains with over 77 stores as of early 2025. They listed on the Singapore Exchange in 2011. Their business model? Simple but effective, focus on the mass market, especially in Singapore's heartland HDB estates. They offer a wet and dry shopping experience. Think fresh seafood, meat, and veggies alongside all your pantry staples and household goods. The key is value for money. They achieve this through efficient operations, including their own distribution and food processing facilities, and a huge range of over 1,650 house brand products across 23 brands, offering quality alternatives at lower prices. This focus on value is really hitting the mark in today's inflationary environment. Singapore's supermarket scene is fiercely competitive. Sheng Siong is the third largest player. Ahead of them is the market leader, NTUC FairPrice, a cooperative with over 370 outlets and a massive market share of around 49%. FairPrice is pushing hard on its digital strategy, integrating online and offline experiences with things like Scan and Go Tech and personalized recommendations. Then there's DFI Retail Group, operating cold storage for the premium market and Giant for the value segment. Giant, however, has been facing challenges, closing stores, particularly in HDB areas where Sheng Siong is strong. In a major shakeup, DFI's entire Singapore food retail business, including cold storage and Giant, is being acquired by Malaysian group Macrovalue, with a deal expected to complete later in 2025. This could mean more store closures for Giant, potentially benefiting Sheng Siong. Analysts actually project Sheng Siong is gaining market share, potentially reaching over 20%, growing faster than the industry average. Their value focus and house brands are key strengths, especially with rising costs and GST hikes making shoppers more price-conscious. The potential retreat of Giant from heartland areas is a direct opportunity for Sheng Siong to grab customers and locations. So, how are Sheng Siong's finances looking? Let's break down their recent performance. For the full year 2024, revenue grew a solid 4.5% to 1.43 billion Singapore dollars, mainly thanks to new stores. Gross profit margin improved nicely to 30.5%, helped by selling more high-margin fresh products and house brands. But here's the challenge. Operating costs jumped significantly, especially staff costs due to bonuses, wage adjustments, and hiring for new stores, plus higher utility bills. This meant net profit only grew by a modest 2.6% to 137.5 million Singapore dollars. The pressure was particularly felt in the last quarter of 2024. Moving into the first quarter of 2025, the trend continued. Revenue was up 7.1% to 403 million Singapore dollars, again driven by new stores and a boost from Hari Raya sales. Gross margin improved further to 30.3%. However, operating costs kept climbing, up 12.4% year-on-year, again led by staff costs. Net profit for Q1 2025 landed at 38.5 Singapore dollars to 38.6 million Singapore dollars, a 6.1 to 6.2% increase year-on-year, which was slightly better than analysts expected. The key takeaway? Sheng Siong is great at managing its product mix to boost gross margins, but rising operating expenses are eating into bottom-line growth. Also, growth is heavily reliant on opening new stores, as sales growth in existing stores has slowed right down. Despite cost pressures, Sheng Siong's overall financial health looks very strong. They have a hefty cash pile, over 366 million Singapore dollars as of March 2025. This gives them a lot of flexibility to fund expansion and pay dividends without borrowing much. And speaking of borrowing, they have very little debt. Their balance sheet is conservative and stable. They consistently generate strong cash flow from operations, even though Q1 2025 saw a temporary dip due to payment timings. Profitability ratios like return on equity are impressive, reported around 26.7%, indicating they use shareholder money efficiently. Overall, a very robust financial position. Let's talk about the stock. How has it been performing, and is it good value? As of early May 2025, the stock was trading around 1.74 Singapore dollars to 1.76 Singapore dollars, near its 52-week high. It's shown strong positive momentum, up over 12% in the past year. Interestingly, it has low volatility and a very low beta, 0.16, meaning it doesn't swing wildly with the overall market. Now, valuation. Sheng Siong trades at a premium compared to its peers. Its price-to-earnings ratio is around 19x, while competitors are closer to 10-11x. Similar premiums exist for price-to-sales and price-to-book ratios. This suggests the market really values its reliability and growth prospects, but it also means high expectations are baked in. On the plus side, it offers an attractive dividend yield of around 3.6% to 3.9%, with a consistent payout of about 70% of profits, making it appealing for income investors. Technical indicators also look bullish, showing a strong uptrend since mid-2024, with key support and resistance levels identified. However, some indicators suggest it might be slightly overbought in the short term. What's Sheng Siong's strategy moving forward? The core remains the same: value, quality, and service, especially for heartland consumers. But the big focus right now is aggressive store expansion in Singapore. What about China? Sheng Siong entered Kunming in 2017. They opened their 6th store there in mid-2024. However, progress is slow. It contributes very little to revenue, under 3%. And the China operations actually reported a loss in Q1 2025 due to costs from the new store. Management sees it as a long-term play, but it's clearly challenging and not a near-term growth driver. Beyond expansion, they're focused on efficiency. This means improving the sales mix towards high-margin fresh goods and house brands, better sourcing, diversifying suppliers, and investing in technology like automation and potentially AI to manage rising labor costs. They also have their online platform, allforyouryu.sg, though their digital push seems less aggressive than FairPrice. Sustainability is also on the agenda, with annual ESG reports covering environmental, social, and governance efforts. So, what does the future hold? Management is cautiously optimistic, banking on their value proposition resonating with cost-conscious consumers. Analysts generally agree, forecasting steady earnings growth, boosted by the rapid store openings. Key opportunities: market share gains, grabbing customers and locations from competitors like Giant, especially if the macro-value acquisition leads to more closures. Store expansion, successfully opening and integrating the planned 8 to 10 new Singapore stores in 2025. Margin improvement, continuing to boost margins through better sales mix and operational efficiencies. Consumer trends, benefiting from ongoing focus on value and potential government support measures. China, long shot if they can crack the code in Kunming. It offers huge long-term potential, but that's a big if right now. But there are significant risks. Intense competition, fair price is strong, and the new DFI owner could revitalize giant cold storage. Cost pressures, managing rising staff, energy, and rental costs is critical. Expansion execution, opening so many stores quickly carries risks. Finding sites, managing costs, hiring staff, and ensuring profitability. China risk, continued challenges in making the coming venture profitable. Supply chain issues, vulnerability to global disruptions affecting costs and availability. Valuation risk, the premium stock price could fall if growth disappoints. The big balancing act is executing the Singapore expansion while keeping costs under control. So, wrapping up on Sheng Siong, it's undoubtedly a well-run, financially healthy company with a strong brand and a clear strategy that fits the current economic climate. Their aggressive expansion in Singapore is a major positive, offering a clear path to growth. The reliable dividend is also a plus for many investors. However, the persistent rise in operating costs is a major hurdle they need to overcome to ensure profit growth keeps pace. Competition remains fierce, and executing the rapid expansion flawlessly isn't guaranteed. The China venture remains a question mark. From an investment perspective, Sheng Siong offers defensive qualities and income. But that premium valuation means you're paying for quality and expected growth. The key question is whether they can continue to execute effectively and manage costs well enough to justify that price. It's a high-quality operator, no doubt, but success hinges on navigating those cost pressures and integrating its growing network smoothly. What do you think about Sheng Siong? Let me know your thoughts in the comments below. If you found this analysis helpful, give it a thumbs up, subscribe for more content, and hit that notification bell.